Crypto taxes just got a lot more complicated. And I don't mean in the usual, yeah, crypto is confusing type of way that people have been saying for years. I mean, the IRS rolled out an entirely new reporting system, and for the first time ever, your exchange may be telling them exactly what you sold and for how much. So if you're still handling crypto taxes the same way you did a couple of years ago, waiting until tax season, downloading some CSVs, hoping everything lines up, that approach is getting a little dangerous. I've spent the last 9 years working in crypto tax, helping reconcile thousands of portfolios from simple Coinbase accounts to people with tens of thousands of transactions across wallets and DeFi. And in this video, I'm going to break down what actually changed, why the old approach doesn't work anymore, and what you need to do right now to stay compliant without overpaying. Most people are still playing by the old rules, but hopefully not you. The IRS can finally see what you're doing. For most of crypto's history, taxes were basically an honor system. Exchanges didn't consistently report your trades. In some cases, you might get a tax form for staking rewards or other crypto income, but your gains and losses mostly self-reported. And that's what's changing. Starting with 2025 transactions, we now have Form 1099-DA. This matters because the IRS now has more third-party reporting to compare against your return, because centralized exchanges are now required to report certain crypto transactions directly to the IRS. This is the crypto version of when stockbrokers started issuing 1099-Bs. So now if you sold 50K worth of crypto on an exchange, there's a good chance the IRS already has that number. And if your return doesn't match, that's where problems start. But here's the catch. Knowing what you sold is only half of the story, because the IRS still needs to know what it cost you. And that just got a lot harder. So this is where most people get caught off guard, because the way you track your crypto cost basis actually changed. Before, most people use a kind of universal pool. You bought ETH on Coinbase, bought a little more on Kraken, and when you sold, your basis could come from that combined pool. Now it's wallet by wallet tracking. If you sell from one account, you must use the basis from that specific account. And this becomes a nightmare fast, because real crypto usage looks something like this: buy, transfer, swap, bridge, stake, move your crypto again, and then sell somewhere else. Let's say you buy 2 ETH on Coinbase, move 1 ETH to MetaMask, and then sell from MetaMask. Now you need to prove where that ETH came from, what it cost, and how it moved. The cost basis essentially follows the asset. If that chain breaks, you either overpay or underreport. And this is where spreadsheets start to fall apart. This is also where people realize they need a system, not just exports. Because once you're dealing with multiple wallets, transfers, DeFi activity, tools like token tax stop being optional. They become the only realistic way to actually track this correctly. Now, here's the thing. Even if you get all of this right, there's still a massive blind spot people aren't thinking about: the DeFi blind spot. Everyone's focused on 1099-DA, but the real risk is what it doesn't cover, because DeFi activity is mostly not included. Swaps on decentralized exchanges, liquidity pools, staking rewards, yield farming, none of that shows up neatly on a tax form. And this is where people make some dangerous assumptions. People may say, if it's not reported, maybe it's not a big deal. That's just wrong, because it's still taxable. Every swap, reward, LP interaction can create a tax event. And here's a twist. The 1099-DA actually makes this risk worse, because now the IRS can clearly see your exchange activity, but there are gaps where your DeFi activity should be, and those gaps actually stand out more now. It's like reporting your salary, but ignoring your freelance income. The absence becomes the signal. So now we have more IRS visibility, harder cost basis tracking, and hidden DeFi exposure. So what do you actually do about it? Before we get there, there's one big opportunity most people are missing: the tax advantage nobody is using. One tax advantage crypto investors still have under current law is that the wash sale rule generally does not apply to digital assets the way that it does to stocks. That means investors may be able to realize a loss on a crypto position without being locked out of re-entering the market under the traditional 30-day wash sale framework. That's one reason tax loss harvesting can be more flexible in crypto than it is in equities. But there are a few important caveats. First, this does not automatically apply to every crypto-related product. For example, crypto ETFs can be treated differently. Second, this is an area policymakers have looked at before, so it's not something I describe as permanent. And third, just because the wash sale rule may not apply in crypto in the traditional sense does not mean every loss harvesting pattern is equally defensible. So if you're going to use this strategy, clean records and actual thoughtful execution matters, because the value of tax loss harvesting depends on being being able to substantiate the transaction history and the loss itself. If you're finding this useful, drop a like on this video. It actually helps more people see it, and there are a lot of crypto holders who need to hear this before they file. Now, let's zoom out, because this isn't just about tactics. It's about a more disciplined way of handling crypto taxes. The new playbook. The old model was simple. Trade all year, figure it out in March. That just simply doesn't work anymore. The new playbook has 3 parts. So 1, real-time tracking. Every transaction gets recorded as it happens, not months later, not guessed. Because once data is broken, fixing it can be super painful. 2, wallet by wallet reconciliation. You need to know where assets came from, how they moved, and which lots you're selling. This is where most mistakes happen. And again, this is why tools like Token Tax fit naturally here. They handle transfers, basis tracking, and reconciliation across accounts. 3, proactive tax planning. Instead of asking, what do I owe? You start asking, what should I do now to reduce taxes later? That means harvesting losses during dips, managing gains, avoiding messy transfers. So crypto tax is no longer a one-time task, it's an ongoing system. So now that you know the new rules, the next question is, what actually gets you flagged? Because the IRS isn't just collecting data, they're looking for patterns. So click this video right here, where I break down the 5 biggest crypto tax red flags and how to avoid them. I'll see you there.